Morgan, I am not surprised. We have to remember that this is all happening with a very accommodative monetary policy backdrop. And I think that really has created an upward bias for stocks and enables such an outsized reaction to mildly positive news.
Jeff, how do you see it?
I would have to agree for the most part. Markets certainly did punch above their weight last year. So I wouldn't be surprised to see some sort of pullback in here, but we remain very constructive on these markets. Not only an easy Fed, which was mentioned previously, but you have sort of decent valuations here, certainly not cheap. But when you throw in low inflation and low rates, you actually have stocks that are reasonably priced. You have earnings season coming up, so perhaps other catalysts going forward. So I continue to see markets which will probably grind higher. We think, single-digit returns are probably in the cards this year. And so we are advising our clients to sort of remain in equities with a bias towards the U.S.
Kristina, how about you? I mean, are U.S. equities still the best place to be parking your money as an investor right now, or would you be telling clients to look elsewhere?
What I would tell clients to do is be well diversified. So I would agree with Jeff that we're going to see single-digit returns in the U.S., but that doesn't mean we have to throw up our hands and accept that. We can look outside the U.S., and I would expect significantly higher returns from emerging markets equities, particularly Chinese equities in 2020.
So, Jeff, looking at global growth for the year, it looks like you expect the consumer to continue pulling the U.S. economy to help the U.S. economy continue to strengthen here. How are you thinking about that balance between the U.S. versus the rest of the world?
So we do have a neutral weighting to equities, but we are overweight the U.S. relative to the rest of the world, and we're actually underweight emerging markets. So I guess we're making a market right on this show. Emerging markets, to us, there's risk there. You're also in a late cycle in the U.S., and historically, U.S. equities tend to dominate towards the end of its cycle. So we'll have to see if that transpires this time around. We like growth stocks over value stocks. We like large cap over small. As bull markets age and eventually do peter out, they tend to be dominated by past winners and momentum type names. You continue to see that, as Jim Cramer has pointed out, the FANG names continue to do incredibly well. Even this year, growth over value by 150 to 100 to 150 basis points a year to date, even so far. So we think it's a continuation. Although we as human beings turn the calendar over on December 31st, markets tend not to do that. And so you're seeing a continuation. We think you see a continuation in 2020 of what we saw in 2019, but to a much lesser degree, of course.
Kristina, you mentioned the accommodative Fed. Given the gains we saw in both treasuries last year and U.S. equities, would you expect that type of similarity to continue this year? Where do you think rates are going?
So I would expect that rates stay pat in 2020. But we can't ignore a more important phenomenon, at least for emerging markets equities, and that's the fact that balance sheet normalization ended in September. And Jeff alluded to the trend in 2019, but if we actually look at the trend for the last quarter of 2019, which is after balance sheet normalization ended, what we saw was EM outperform U.S. and Chinese equities outperform EM. The other key catalyst for Chinese equities, of course, is going to be the signing of the Phase 1 trade deal. So I would expect going forward that we will see EM perform strongly, particularly China, in 2020.
Jeff, what are the biggest risks to your investment thesis this year? Is it geopolitics? Is it something else?
I think there are some known unknowns this year. Markets are pretty good at discounting presidential elections, but that I think may keep investors on edge, especially during Super Tuesdays or some larger caucuses that come through in 2020. Geopolitical issues, things that cannot be mapped or modeled. I think we've already got a taste of that in early 2020. So there's certainly the shock, which can have negative impacts in the oil markets potentially, and also to risk assets and to multiples. Certainly last year you got a lot of multiple expansion, not a lot of earnings growth. So I think this year we're calling that earnings will have to lug the water. And so anything which puts downward pressure on multiples would put downward pressure on price without enough earnings to sort of come through. So I think to answer your question, it's the things that cannot be mapped or modeled. And we agree that a well-diversified portfolio will probably serve investors well in 2020.